SoFi Technologies Inc., trading under the ticker SoFi on the Nasdaq, currently stands at 25.06, experiencing an intraday decline of 1.88%. This movement brings it further away from its recent 52-week high of 26.61, but it remains a staggering distance from its 52-week low of 6.75. The immediate market narrative sees a stock that has had a monumental run, more than quadrupling from its lows, now facing the predictable pressures of profit-taking and a cooling sentiment. However, the superficial story of a simple pullback belies a far more intriguing undercurrent. The expectation is that SoFi's rapid ascent was a result of a fleeting market sentiment shift, a short-term trade based on one or two good earnings reports. The reality, which few are discussing with the necessary depth, is that this wasn't a blip, but a profound, fundamental re-rating of the company's valuation, catalyzed by a strategic pivot that has now been fully validated by its Q2 2025 earnings report. The stock's performance isn't just a function of a bullish trend. It's a direct reflection of a business model that has finally reached a critical inflection point, achieving sustained profitability and demonstrating an accelerated path to becoming a true financial powerhouse. This is the new reality that the current daily price action, with its minor dips, fails to fully capture. The recent price action for SoFi is a masterclass in market psychology. We've seen a series of explosive moves, primarily following their Cone and Q2 2025 earnings reports. The Q2 report, in particular, was a watershed moment. The company didn't just meet expectations, it shattered them. Net income came in at $97 million, a nearly five-fold increase year over year, while diluted EPS reached 0.08, a substantial beat over the 0.06 consensus forecast. Adjusted net revenue also surged, climbing 44% year over year to a record $858 million. The market initially reacted with euphoric buying, pushing the stock up over 16% in pre-market trading on the day of the announcement. This is the exceeding expectations part of the story. However, what has happened since is the more nuanced and critical observation. Trading volumes have remained elevated, but we're seeing a back-and-forth struggle. This isn't just profit-taking from retail investors. It's a significant reshuffling of institutional ownership. While the Vanguard Group and BlackRock, two of the largest holders, have increased their positions, other major players like D.E. Shaw Company have been decreasing their stake, while new players like Jane Street Group have made massive increases. This dynamic tug-of-war in institutional ownership tells a much more significant story than a simple chart dip. It suggests that while some institutions see the recent run as an opportunity to trim positions, others are using any slight weakness as a buying opportunity, fundamentally believing in the company's new profitability paradigm. This is a crucial distinction. The market narrative is focused on the price chart's volatility, but the underlying reality is a fight for control over a stock whose long-term trajectory has been profoundly altered by the last 2 quarters of performance. The second body section needs to be even stronger, digging into the core of what is truly driving this institutional re-rating. While the earnings beats were the flashpoint, the underlying driver is SoFi's transformation from a lending-first fintech to a diversified financial services ecosystem with a powerful, sticky, and increasingly profitable banking arm. The common belief is that SoFi is a volatile, high-growth tech stock that is susceptible to interest rate fluctuations and credit cycles. The deeper reality is that its strategic shift, culminating in the attainment of a bank charter, has fundamentally insulated it from some of these pressures and created a new, robust revenue stream. Consider this. Net interest income for Q2 2025 was up 26% year over year to $517.8 million, driven by a 24% increase in average interest-earning assets. This is the lifeblood of a traditional bank, and SoFi is now successfully harnessing it. Moreover, the cost of funds decreased, a rare feat in the current macroeconomic climate, while the net interest margin expanded. This is not the profile of a fledgling fintech. It is the financial profile of a well-run bank, yet it's not being valued as one. This dual identity, a high-growth tech company with a robust traditional banking foundation, is the central tension and opportunity. The company's technology platform, which powers other financial institutions, is also a quietly accelerating engine, with accounts reaching 160 million. This dual engine of growth, a profitable lending business buttressed by a growing, fee-based tech platform, is what fundamentally re-rates the company from a speculative bet to a legitimate contender in the financial services landscape. The ability to cross-sell products, from personal loans and student loan refinancing to credit cards and investment accounts, creates a flywheel effect. Each new member added through one product is a potential customer for a dozen others, and the latest quarterly report showed a record addition of 850 new members, bringing the total to over 11.7 million. The sheer scale and velocity of this ecosystem growth are the real story, far more compelling than a single day's price dip. This is not just a business that is growing. It is a business that is integrating and deepening its relationship with its customers, building a moat of interconnected services that will be incredibly difficult to replicate. Do you think the market is adequately valuing the cross-selling potential of SoFi's ecosystem? Or is it still too fixated on its legacy lending business? Comment below with your thoughts on how many products you use with a single financial institution. Shifting our focus to the future, the outlook for SoFi is framed by a number of powerful, intersecting macro and micro catalysts. The central narrative of expectation is that the company's growth will slow as the macro environment tightens and competition intensifies. The contrarian reality, however, suggests several factors are poised to accelerate SoFi's trajectory. First, the student loan moratorium, a long-standing headwind, has been a significant drag on a core part of their business. As federal student loan payments fully resume and new policies take hold, there is a massive pent-up demand for student loan refinancing that SoFi is uniquely positioned to capture. This is a powerful, long-term catalyst that could provide a steady tailwind for years to come. Second, the broader macroeconomic environment, while challenging for some, is actually playing into SoFi's strengths. With interest rates remaining elevated, consumers are actively seeking better rates and more efficient financial management tools. SoFi's platform, which offers everything from high-yield savings accounts to credit score tracking, becomes increasingly attractive in this climate. The company's focus on a higher net worth customer base provides a degree of insulation from the worst of consumer credit deterioration. On a micro level, the company's continuous product innovation, from its home loan business to its nascent crypto offerings, represents a pipeline of future growth opportunities. Management has been clear about their goal to become a top 10 financial institution, a highly ambitious target that requires a consistent expansion of their product suite and market share. The risks, of course, are real. A sudden and severe recession could impact loan performance and slow new member growth. Regulatory scrutiny in the fintech space is a constant overhang, and any new legislation could create unexpected hurdles. However, the company's move to a bank charter has already addressed some of these concerns by placing them under a more traditional regulatory framework. The final act of this story will be determined by whether SoFi can continue to execute on its ecosystem strategy, converting its rapid user growth into sustainable, long-term profitability across all segments. The expectation is that they will hit speed bumps. The reality, based on recent performance, is that they have built a machine that is proving to be more resilient and dynamic than the market gives it credit for. In summary, the story of SoFi Technologies is a compelling narrative of a company that has moved beyond the simple expectations of a high-growth fintech. The recent market action, while appearing to be a simple pullback, is in fact a complex dance of institutional re-rating. We have contrasted the public narrative of a volatile stock with the deeper reality of a company that has successfully pivoted to sustained profitability, leveraging its bank charter to create a robust, interest income-driven foundation, while continuing to scale its tech-driven ecosystem. The Q2 2025 earnings report was not just a single data point, but the confirmation of a profound shift in its business model. Looking forward, the company is poised to capitalize on powerful macro catalysts, such as the full resumption of student loan payments, while its micro-level strategy of continuous product innovation and ecosystem expansion sets the stage for a lasting and defensible competitive advantage. The expectations for SoFi were high, but its recent reality has proven to be even more compelling, suggesting that this isn't the end of a run, but the beginning of a new, more mature phase of growth.